It's funny. If you brace your arm right, the X-ray gives you this nice, jagged white line, and the doctor points right at it.
Right.
There it is. Broken or not broken. It's clean, it's binary, and honestly, it's kind of comforting. Like, we really like things to be visible and categorized.
Absolutely. We crave that certainty.
Exactly. But then you step into the world of personal finance and like wealth building, and that X-ray machine is just completely broken.
It's just static.
Yeah, it's just noise. You're told you need $1 million to retire, but then you're also told you shouldn't skip the daily things that bring you joy. But oh wait, the market might crash tomorrow, but you also have to be invested, or inflation is going to, eat you alive.
It's pure, unfiltered diagnostic anxiety for most people.
It really is.
It is the absolute definition of muddy waters. Because for anyone standing on the outside, looking in, trying to figure out the actual health of their financial future, the noise is just deafening. And honestly, the financial industry kind of thrives on that confusion.
Oh, 100%.
They want it to look like a black box, so you feel like compelled to pay them a hefty fee to manage it for you.
Exactly. And that is exactly why you, the listener, are here with us today. Because we know you want to cut through that noise. You want to strip away the theoretical jargon, the sales pitches, and just look at the actual math.
The real numbers.
The real numbers.
Yeah.
So today we are going on a deep dive into a massive stack of real-world data to explore the actual reality of microinvesting. We're looking at what genuinely happens when you put away just $10 or £10 a day.
Or even less in some cases.
Right. Does that tiny, seemingly insignificant amount of capital actually build real wealth? Or is it just, a drop in an ocean of institutional money?
And to figure this out, we aren't just looking at like one lucky trader or some hypothetical spreadsheet that assumes perfect conditions.
Right, because those are useless.
Completely useless. We've aggregated actual real-world experiments, historical back testing, and daily vlogs from a whole spectrum of creators and financial analysts. We've got data from Pasha IRL, Buckwise Money, Mitch Shoesmith, Financial Interest, Mel Abraham, and Jacob Wade.
Yeah, and we also have Dom's story mixed in there too, which we'll touch on. That one is super interesting. It's just, I invested $10 a week for 1 year. Here's exactly what happened. Real results. Honest numbers.
Yeah, $10 a week.
Yeah.
Which is an incredible starting point. And the data we have across all these sources is just incredibly robust because of the varied environments these experiments were actually run in.
Right. This isn't just a straight line up in a bull market. We've got a 30-day crash test where a guy starts dropping 10 pounds a day, literally the exact week the global markets meltdown.
Talk about bad timing.
The worst. And then we've got a 1-year passive ETF strategy navigating through a global trade war. We have a 1-year active stock picking portfolio that generated just massive alpha. And then we take it all the way out to these 30-year mathematical projections. So we are looking at the micro, the medium, and the macro timelines here.
It's comprehensive.
Very. So, okay, let's unpack this. Before we get into the actual results of these portfolios, we kind of have to understand how this is even possible today.
Yeah, we have to establish the landscape. Because if you look at the data from the Buckwise Money analysis, they highlight this really fundamental shift in market mechanics between the early 2020s and where we're sitting right now in 2026.
It's night and day.
It really is. If you were investing from, say, 2020 to roughly 2024, you were basically playing on easy mode. The source cites these BlackRock analysts noting that over 90% of S&P 500 companies had positive returns during that stretch.
Wow, over 90%.
Yeah, it was an era of zero interest rate policy, massive government stimulus, and that whole post-pandemic tech boom. Money was virtually free to borrow.
Right, and when capital is that cheap, even what they call zombie companies, like companies that literally don't generate enough profit to even cover the interest on their own debt, they can just refinance and survive.
Exactly. They just roll the debt over.
So you could throw a dart at a list of the 500 biggest companies while blindfolded, and like 9 times out of 10, you'd make money. It bred this culture of everyone feeling like an absolute genius because a rising tide was lifting every single boat, even the ones with, massive holes in the hull.
Precisely. But that era of free money ended violently. By 2025, the music stopped. The data shows that around 40% of the S&P 500 finished 2025 in negative territory.
It's a huge swing.
It's massive. The market became incredibly selective. So analysts are calling our current 2026 environment an investor's market, which fundamentally contrasts with that speculator's market of the early 2020s.
Right, because in a speculator's market, you buy, a JPEG of a rock or a deeply unprofitable tech company just hoping someone else pays more for it tomorrow.
The greater fool theory.
Exactly. But an investor's market forces you to return to the fundamentals. It rewards discipline, consistency, cash flow, actual value generation. The flashy, aggressive trend chasing really burns capital in this
It
environment.
destroys it.
Yeah. The boring, methodical habits actually trump the brilliant, lucky gambles right now. And honestly, it's the perfect environment to test a strategy like $10 a day or $10 a week like Dom did because it requires absolute systemic discipline.
And we have to talk about the technological enabler that even allows a $10 a day strategy to exist in the first place. Because obviously, the barrier to entry used to be massive.
Oh, yeah, like unapproachable for most people.
Right. If you wanted to buy a single share of a major tech company a decade ago and it was trading at $3,000, you had to accumulate $3,000 in hard cash. You couldn't just drop 10 bucks in.
Which is why the advent of fractional shares is arguably the single greatest democratization of the stock market in our lifetime.
Absolutely.
The algorithms and the clearinghouses on the back end of these modern brokerages have just completely evolved. Now, if you have $10 and a stock is trading at $200, you don't have to wait. You hit buy, and the platform automatically converts your $10 into zero point 0.05 shares.
And the back-end mechanics of this are actually brilliant if you geek out on that stuff. Retail brokerages essentially buy whole shares on the open market, hold them in a massive centralized master account, and then they use their internal ledgers to allocate fractional rights to their users.
So you get the exact same proportional economic benefits as someone buying $1 million worth of the stock.
Exactly.
Like, think about walking into a high-end bakery. There's this incredible premium multi-tiered wedding cake sitting in the window, and it costs like $500.
Okay, I'm tracking.
Historically, the baker would say, you have to buy the whole cake or you get nothing. So the working class just kind of stares through the window. But fractional investing is the baker saying, oh, you only have $5. Cool. I'll take a scalpel, cut you exactly $5 worth of this premium cake, and put it on a plate.
That's a great way to look at it.
Right. You're eating the exact same high-quality asset as the billionaire who bought the whole thing. You experience the exact same percentage of growth. And if the company pays a dividend, you get a fractional percentage of that dividend deposited directly into your account.
And the platforms facilitating this in 2026 have just completely eliminated the friction. The sources highlight Fidelity as really the top tier for beginners right now. Zero commissions, zero account minimums, and seamless fractional execution.
Yeah, Fidelity is great.
And then you have Charles Schwab, Robinhood, Webull, and over in the UK and Europe, Trading 212. They're all operating on the zero-fee fractional model.
But, okay, this brings up a massive psychological paradox for me. If the technological barriers are gone and the financial barriers are literally zero, meaning there are no trade fees eating up your tiny $10 investment, why isn't everyone doing this? Why is so much capital still sitting on the sidelines getting quietly eaten alive by inflation?
Because human inertia is the heaviest force in personal finance.
Yeah.
The Buckwise Money deep dive points this out perfectly. The absolute hardest part of this entire multi-decade process isn't picking the stocks. It's the first 10 minutes.
Just getting started.
Right. It is the psychological weight of downloading the app, typing in your personal information, securely linking your primary bank account, and actually pushing the button to transfer the first $10. People are terrified of the unknown. They fear making a structural mistake, so they default to doing nothing.
Yeah, paralysis by analysis. So let's assume the listener pushes through that inertia. They link the account. The $10 clears. Now they're staring at a search bar with like 10,000 individual stock tickers. That is paralyzing.
Right.
And the sources all coalesce around the foundational strategy for the micro investor here, utilizing ETFs.
Yeah, we all understand that an ETF, an exchange-traded fund, provides instant diversification. It acts as a basket of securities. But what's critical here is how these sources are weaponizing standard broad market index funds like VOO, VTI, and QQQ against the noise of the financial industry.
Right. VOO gives you the S&P 500, VTI captures the total U.S. stock market, and QQQ concentrates on the NASDAQ Q100, which is more tech-heavy and volatile. These are your foundational building blocks.
Yet the sources also issue a massive warning about the 2026 ETF landscape. It has become an absolute minefield for beginners.
Oh, it's wild out there now.
Over 1,100 new ETFs launched recently, and over a third of them are classified as highly risky. We're talking leveraged ETFs, inverse ETFs, single stock ETFs.
This raises an important question, though. Why? Why is the financial industry pushing these insanely complex, risky tools to beginners on these simple apps?
Because Wall Street knows that broad, boring index funds are the best play for retail investors, but boring doesn't generate massive trading fees. So they are flooding the zone with these complex, hyper-risky products wrapped in the very approachable ETF label.
Just to trick people into trading more.
Exactly. And they are mathematically designed to destroy long-term wealth. Like, let's look at the mechanics of a leveraged ETF, say, one that promises 3 times the daily return of the NASDAQ.
Okay.
If you hold that for months or years, you suffer from something called volatility drag. If the underlying index drops 10% in a day, your leverage ETF drops 30%.
Ouch.
Right. So if you started with $100, you're down to $70. The next day, if the index goes up 10%, your ETF goes up 30%.
Okay, so you're back to even.
No, that's the trap. A 30% gain on $70 only brings you back to $91. The index itself is almost back to break even, but you have suffered permanent capital decay. You're out $9 forever. These are derivative instruments meant for day traders to hold for, like maybe 4 hours to hedge positions, but they are marketed right alongside VOO and VTI on retail apps. It's dangerous.
So the discipline really lies in sticking to the boring baskets. Boring wins, right. But the strategy isn't just what you buy, it's the vehicle you hold it in. And the sources aggressively recommend shielding these micro investments inside a tax-advantaged account, specifically a Roth IRA if you're in the U.S.
Absolutely crucial.
Looking at the 2026 numbers, if you're under 50, the contribution limit is $7,500 a year. If you're 50 or older, it's $8,600. And there are income caps. You have to make under $153,000 as a single filer, or under $242,000 if you're married filing jointly.
The mechanical advantage of the Roth IRA cannot be overstated here. You are funding it with post-tax dollars. You've already paid the income tax on that money at your regular job.
Right.
So when that $10 compounds over 30 years into, say, $10,000, and you go to sell that asset in retirement, the capital gains tax is zero.
It is a complete blockade against the taxman. You keep every single cent of the growth.
Entirely. In a standard brokerage account, capital gains taxes can rip 15% to 20% of your total compounded profit right out of your hands at the finish line.
Which is brutal.
It is. When you are micro-investing, you're relying entirely on the extreme end of the compounding curve to build wealth. Giving up a fifth of that final compounded number is catastrophic. The Roth IRA is the ultimate defensive shield for the $10 a day investor.
Okay, so we have the mechanism, fractional shares. We have the asset, the broad market ETF. We have the shield, the Roth IRA. Now we take all of that pristine logical theory and we throw it directly into a wood chipper.
Right into the fire.
Because we need to look at what happens when human psychology meets a violently unpredictable world. Let's dig into Mitch Shoesmith's 30-day trial by fire.
Mitch's experiment is just an incredible case study in enduring systemic shock. He sets up this challenge. Invest £10 a day for 30 days on Trading 212. He's putting it into the Vanguard FTSE All-World ETF.
So he's capturing the entire global equity market. US, Japan, UK, China, India, all of it.
Exactly. And on day 5, the global market fundamentally breaks.
He wakes up to absolute, unadulterated carnage. It was early August, and the Nikkei 225, which is Japan's premier stock index, plummeted 12.4% in a single trading session.
Unprecedented.
It was the worst localized sell-off since Black Monday in 1987. And because global equities are so interconnected today, it triggered this massive contagious panic. U.S. markets instantly dropped into correction territory, tech stocks started bleeding out, and Mitch is sitting there, literally 5 days into his modest 10-pound-a-day challenge, watching the entire financial system convulse.
And to understand the sheer scale of the panic, we have to look under the hood at the actual plumbing of the global financial system. Mitch outlines this in his analysis, and what's fascinating here is that the trigger wasn't a sudden failure in corporate earnings.
Right. It wasn't like a company went bankrupt.
No, it was the violent unwinding of something called the Japanese carry trade.
Okay. This is one of the most fascinating systemic vulnerabilities I've seen in the data. Walk us through the mechanics of a carry trade. Because from the outside, it really just looks like Wall Street was playing this incredibly leveraged, rigged game that suddenly blew up in everyone's face.
It pretty much was. The carry trade is a pure interest rate arbitrage strategy. For years, the macroeconomic environment was deeply bifurcated.
Meaning split in two.
Right. The Western world, so the Federal Reserve, the Bank of England, the European Central Bank, was aggressively hiking interest rates to combat post-pandemic inflation. Borrowing money became expensive, pushing 5%, 6%, even 7%.
Mortgages were through the roof.
Exactly. But the Bank of Japan was fighting a completely different war. They had battled deflation and economic stagnation for decades, so they kept their interest rates artificially suppressed through yield curve control. Their rates were near zero, sometimes actually negative.
Okay, so you have a globalized financial system where capital can move instantly. And in one major economy, borrowing money costs 6%, and in another, it costs almost nothing.
Exactly. And institutional capital is entirely predatory when it comes to yield. Massive hedge funds and global asset managers looked at Japan and essentially saw an infinite money glitch.
Of course they did.
They went to Japanese institutions and borrowed billions of yen at roughly 1.5% interest. They took those yen, exchanged them on the Forex market for U.S. dollars, and used those dollars to buy high-yielding U.S. assets.
So the theory being, you borrow at 1.5%, you buy a safe U.S. Treasury bond yielding 5%, and you just sit back and collect the 3.5% difference without risking any of your own underlying capital. That actually sounds somewhat rational.
If they had stuck to safe sovereign debt, the root would have been minimal. But greed dictates that if you have access to functionally free leverage, you maximize the return.
Ah, right. They didn't buy treasuries.
Many of them didn't. They took that cheap Japanese debt and plowed it into highly volatile U.S. risk assets, specifically the mega-cap tech stocks driving the AI boom, like NVIDIA and Tesla.
Wow. It's like taking out a massive cash advance on a 0% introductory APR credit card. And instead of putting that cash in a high-yield savings account to scalp the interest, you walk into a casino, sit at the roulette table, and put it all on black.
That's the perfect analogy.
But worse, because they were using margin to multiply their bets. They were leveraging borrowed money on top of borrowed money. Isn't this just institutional gambling that retail investors ultimately pay the price for?
It absolutely is. The margin is what made it systemic. And the entire house of cards rested on two very fragile assumptions: that U.S. tech stocks would keep going up forever, and that the exchange rate between the Japanese yen and the U.S. dollar would remain perfectly stable.
And in early August, both assumptions shattered simultaneously.
Right. First, the U.S. printed some slightly weak employment data, which caused those high-flying tech stocks to suddenly correct. Tesla dropped roughly 20%. So the asset these funds bought with borrowed money was suddenly worth significantly less.
Their collateral is just vaporizing.
Exactly. And then the Bank of Japan delivered the lethal blow?
The interest rate hike.
Yes. The Bank of Japan finally signaled they were going to raise their domestic interest rates to defend their currency and manage their own inflation. This caused the value of the Japanese yen to surge aggressively against the U.S. dollar. Mitch's data points out that the U.S. dollar lost about 10% of its value against the yen incredibly fast.
Okay, let's map the math on that squeeze because it's brutal. The hedge fund borrowed yen, they converted to dollars to buy tech stocks. The stock drops 20%, so their collateral is vaporizing. But concurrently, because the yen got stronger, the actual loan they have to pay back is now 10% more expensive when they try to convert their dollars back to yen.
They're getting crushed from both sides of the trade.
And because they were heavily leveraged, the prime brokers who extended that margin panicked.
Right. When your collateral drops below a certain threshold, the broker issues a margin call. They demand an immediate injection of cash to cover the expanding losses, or they will forcefully liquidate your account.
And when hundreds of massive funds get margin called on the exact same day, how do they get the cash? They hit the sell button on literally everything.
They indiscriminately dump assets. They sold their tech holdings. They sold their index funds. They sold anything highly liquid. This forced liquidation creates a cascading supply glut in the market, driving prices down further, which triggers more margin calls for other funds.
It's a doom loop.
It was a structural liquidity crisis masquerading as a market crash. The underlying companies didn't suddenly become terrible overnight. They were just caught in the crossfire of an institutional gamble unwinding.
It's intensely frustrating, honestly, that retail investors like Mitch, who are just quietly putting their 10 pounds a day into a boring ETF, have to watch their portfolio get nuked because an asset manager in Manhattan got over-leveraged on Japanese interest rates.
It's the reality of a globally interconnected market.
But the twist in Mitch's data is phenomenal. Despite launching his micro-investing challenge into the teeth of a generation-defining liquidity crisis, Mitch finished his 30-day experiment up 1.46%.
He survived it.
He did. His 200 pounds invested grew to 292 pounds in total value. How does that math work when the Nikkei dropped 12% in a single day?
It works because of two fundamental pillars of risk management inherent in his strategy.
Okay, lay them out.
The first is geographic diversification. He didn't buy an S&P 500 fund, and he certainly didn't buy a Japanese ETF. He bought the FTSE All-World ETF. Yes, Japan suffered a historic crash, but Japan only made up 6.1% of the total global weighting of that fund. The destruction in Tokyo was deeply diluted by the relative stability of European and domestic U.S. equities. A localized fire couldn't burn down his globally diversified house.
That makes sense. And the second pillar?
Time diversification, which is the core thesis of micro investing. We call it dollar cost averaging, or pound cost averaging in his case. Because Mitch was mechanically investing 10 pounds every single day, he didn't deploy all his capital at the market peak on day one.
Right, he was dripping it in.
When a market plummeted on day 5, his automated 10 pounds bought shares at a massive discount. When it kept dropping on day 6 and 7, he bought even cheaper shares.
He was systematically averaging down his cost basis without having to make an emotional decision. Like, he didn't have to bravely log in and try to perfectly time the bottom of the crash. The algorithm just executed the trade.
Exactly. And as the margin calls finished unwinding, and the broader market inevitably recognized that the underlying companies were still generating massive cash flows, the market recovered. And because Mitch had accumulated all those cheap fractions of shares during the trough, the recovery velocity of his portfolio was exceptional.
So a market crash, when viewed through the lens of a daily micro-investor, mathematically ceases to be a disaster. It actually becomes a mechanized purchasing opportunity. You acquire more fractional equity for the exact same daily cash outlay.
It flips the psychology entirely. But 30 days is still a microscopic sample size. It captures an acute shock. To really understand the endurance required for this strategy, we have to look at a longer timeline.
Yeah, what happens when the shock isn't just an overnight liquidity crisis, but a slow, grinding macroeconomic shift?
Which brings us to the data from the Financial Interest Channel. This is the one-year passive roller coaster.
The setup here is identical to Mitch. 10 pounds a day into the Vanguard FTSE All-World ETF, but sustained over a full calendar year. Now, mathematically, the stock market is closed on weekends and major bank holidays. So over a year, you have roughly 254 actual trading days. This investor is deploying a total of 2,540 pounds.
And the timeline of this specific year serves as a masterclass in market cycles and human psychology. It begins with the honeymoon phase.
Don't they always?
Right. Through the fall of 2024, the macroeconomic indicators were largely cooperative. Central banks were signaling an end to the tightening cycle, hinting at rate cuts. Equity markets generally front-run those cuts, pricing in the cheaper capital, so prices trended higher. By November 2024, the daily investments had generated a 6.2% return.
Nice.
By January 2025, the portfolio peaked at a 7.19% gain.
When you start a habit like this, and you're up 7% in just a few months, the psychological reinforcement is massive. You feel brilliant. You're like, the system works perfectly.
But then, the geopolitical landscape fractures. We move into the 2025 trade wars.
And just to be clear for the listener, we are looking at this strictly from an impartial market mechanics perspective. No politics, just the raw financial data of what occurred.
Absolutely. The sequence of events was brutal for global trade. In February 2025, the U.S. administration aggressively implemented global import tariffs, specifically targeting trade partners like Canada, Mexico, and China.
Which immediately sparked rumors of impending European tariffs.
Right. China retaliated with immediate levies on agricultural and tech imports. And then a massive 50% tariff was announced on semi-finished copper, which is a critical industrial component.
Okay, so when you introduce tariffs on that scale, you are essentially introducing a massive immediate tax on global supply chains.
Great.
For decades, multinational corporations have optimized their logistics for efficiency, relying on cheap, frictionless cross-border trade. When you suddenly tax those imports, corporate profit margins are instantly compressed.
They get squeezed tight.
Because companies face a brutal choice, right? They can raise prices for the consumer, which stalls demand and kills sales volume, or they can absorb the higher costs internally, which directly destroys their earnings per share.
And the stock market is a forward-looking discounting mechanism.
Yeah.
It hates uncertainty more than anything else.
Yeah.
It doesn't wait to see the next quarterly earnings report to see how bad the margins got crushed. It immediately reprices the equities downward based on the anticipated damage.
And the reaction was violent. The source data shows that the portfolio's entire 6 months of steady 7% gains were completely eradicated in just 9 trading days.
9 days.
9 days of geopolitical tension destroyed half a year of disciplined capital accumulation.
And it didn't stop at break even. It kept digging. By April 2025, the relentless daily 10-pound investments were being dragged down into a deep trough. The portfolio hit a catastrophic low of negative 11.97%.
Put yourself in the mind of that investor. You have diligently sacrificed 10 pounds of spending power every single morning for 8 months. You've foregone over 2,000 pounds of discretionary spending. And your brokerage app is glaring red, explicitly telling you that you are hundreds of pounds poorer than if you had just stuffed the cash under your mattress.
The psychological pressure to capitulate at that exact moment is immense. The source analysis actually notes that during this specific window, massive amounts of capital were fleeing the equity markets entirely and flooding into the bond market.
Which is the classic flight to safety. But explain that for a second. When investors panic about a global trade war sparking a recession, why do they universally run to bonds?
Because a sovereign bond, like a U.S. Treasury, is fundamentally a different instrument than equity.
How so?
Equity is ownership. You are entitled to a share of profits, but if the company goes bankrupt, you get nothing. You are at the very bottom of the capital structure. A bond is debt. It is a contractual promise by a sovereign government to pay you a fixed, guaranteed amount of interest over a set duration, and then return your principal in full at maturity.
So it's legally guaranteed?
Yes. During periods of extreme macroeconomic uncertainty, institutional investors prioritize the return of their capital over the return on their capital. They willingly accept lower fixed yields in exchange for the absolute guarantee that their principal is protected by the taxing authority of a government.
Right. This mass rotation of liquidity out of stocks and into fixed income is the mechanical force that drives equity prices down so violently during a panic.
But the investor in the financial interest experiment didn't capitulate. They didn't rotate to bonds. They simply gritted their teeth and allowed the automated system to keep buying the FTSE All-World ETF every single morning, right straight through the absolute bottom of that April crash.
Which is why they ultimately succeeded, because markets constantly reevaluate risk. The initial sell-off in February and March was driven by worst-case scenario modeling. But as the months progressed, the market digested the actual reality of the tariffs.
Supply chains are remarkably resilient.
Yeah, companies found alternative sourcing, specific exemptions were carved out in negotiations, consumer demand remained relatively sticky, the apocalyptic earnings collapse just didn't fully materialize.
So the panic subsided, the market realized equities were deeply oversold, and capital began rotating back in. And because our micro-investor had been blindly accumulating shares at deeply discounted valuations all through April and May, when the market finally rebounded, the portfolio didn't just recover, it exploded upward.
The final tally for the one-year experiment is incredible. By August 2025, the portfolio ended with a 7.4% positive return. That represents a total value of £2,728. They navigated the absolute worst of a global trade war and still handily beat inflation.
And it's worth noting, the source compared this to a pure S&P 500 strategy, which would have yielded 6.35% over the same time frame. The global diversification actually provided a marginal buffer during a highly U.S.-centric trade conflict.
That's a great point.
But the most vital piece of data from this source is the counterfactual analysis. They modeled what would have happened if the investor had succumbed to human nature.
Oh, man. This is the single most important mathematical proof in the entire deep dive. The creator ran the math on panic selling. If an investor had watched that trade war crash unfold, panicked at the exact bottom in April, sold all their shares to protect the remaining capital, waited exactly 1 month in cash for the geopolitical dust to settle, and then bought back into the market,
They would have ended the year down 1.69%.
they would have locked in a loss.
It perfectly illustrates why market timing is a fool's errand. When you sell in a panic, you crystallize a temporary paper decline into permanent financial damage. But more crucially, you almost inevitably miss the steepest days of the market recovery.
Right, because historically, the largest single-day percentage gains in the market occur within weeks of the deepest single-day drops.
Exactly. If you are sitting in cash, waiting for the all-clear signal, you miss the explosive upside that repairs the portfolio. The system of micro-investing only functions if you refuse to flinch. You cannot time the market, you simply have to endure it.
So the passive, boring index strategy proves its resilience. It survives the carry trade shock, it survives the trade wars, and it delivers a steady 7.4%. But what if you look at that 7.4% return and think, that's insufficient? What if you take that exact same $10 a day and instead of buying a blind basket of 3,000 global companies, you actively deploy that capital to hunt for deeply mispriced individual equities?
Now we are shifting from passive accumulation to active management. We're utilizing the data from Pasha IRL's one-year stock picking portfolio. This is a fundamentally different philosophy. This is the attempt to generate alpha.
Meaning returns that exceed the benchmark index?
Right.
Here's where it gets really interesting. Because the raw numbers Pasha achieved over his year of $10 a day investing are genuinely staggering. His portfolio hit $4,800 in total value. He achieved a 29% annual return with a 47% weighted return based on the exact timing of when his capital was deployed.
Which is huge.
He outperformed the S&P 500 by 14%, an alpha of 14. He beat the tech-heavy NASDAQ by 13%. He utterly dismantled the professional benchmarks using pocket change.
And generating an alpha 14 as a retail investor is highly anomalous. I mean, most active mutual fund managers fail to beat the S&P 500 over a long enough time horizon.
So true.
But examining exactly how Pasha constructed his portfolio reveals a highly sophisticated, value-driven macroeconomic approach. He wasn't gambling on meme stocks. He was executing specific theses.
When you deconstruct his specific plays, the biggest drivers of that massive outperformance were Chinese tech equities, specifically JD.com, which generated a 73% return for him alongside Alibaba.
Chinese equities had been treated as virtually uninvestable by Western capital for several years prior. A combination of intense regulatory crackdowns by the domestic government on their own tech sector, combined with deeply sluggish post-pandemic economic data and real estate crises, caused capital to just flee.
The valuations of massive cash-generating companies like Alibaba and JD.com were absolutely decimated.
But Pasha looked past the geopolitical pessimism and looked at the actual accounting. He noted that these businesses were still generating colossal free cash flow, but they were trading at absurdly compressed price-to-earnings, or PE, ratios. He cites JD trading at a trailing PE of 17 and a forward PE around 10.
A forward PE of 10.
Yeah, and the forward PE metric is where the true value thesis lies. A trailing PE just tells you what you were paying for $1 of historical profit from the last 12 months, but market's price in the future. A forward PE compares the current stock price to the earnings analyst project the company will make over the next 12 months. A forward PE of 10 indicates that the market is pricing the equity incredibly cheaply relative to its expected future cash generation. It usually implies the market doesn't actually believe the forward estimates.
But Pasha believed them. He saw an extreme dislocation between the underlying business health and the stock price.
And his timing was impeccable. Because he accumulated these shares when the pessimism was at absolute maximum, he was perfectly positioned when the macroeconomic environment abruptly shifted.
The stimulus.
Exactly. The Chinese government, recognizing the depth of their economic stagnation, suddenly pivoted and unleashed aggressive monetary stimulus to prop up their economy. That flood of liquidity caused those deeply suppressed tech stocks to violently snap back upward, realizing the exact value Pasha had identified.
But identifying the value is only half the trade, right? Pasha's discipline in managing the position is what actually secured the alpha. He didn't subscribe to the diamond hands hold forever mentality.
No, he didn't.
When JD and Alibaba experienced these massive stimulus-driven spikes, he actively liquidated portions of his position. He would sell off 15% to 30% of his holdings into the rally, capturing the profit and taking the risk off the table.
Which is incredibly difficult to do psychologically. When a stock is ripping upwards 70%, human greed screams at you to hold it forever because it might go up 200%.
Yeah, FOMO kicks in hard.
Right. Recognizing that a rally is driven by sudden stimulus rather than a permanent change in business fundamentals and systematically taking profits, that requires ice in your veins.
It's the definition of active management. He rotated that capital.
Yeah.
And he looked for similar dislocations domestically. He bought Intel heavily during extreme dips, specifically noting that he was acquiring shares when they traded under book value around $24.
The concept of buying under book value is fascinating because it implies the market has essentially given up on the company entirely.
Define book value for us.
Book value is the theoretical liquidation value of the corporation. If Intel fired every employee, shut down every single fabrication plant, sold off every piece of equipment, monetized every patent, and paid off every single liability on their balance sheet, The cash left over distributed to shareholders is the book value.
Okay, wow.
When a stock trades below that metric, the open market is explicitly stating that the company is worth more dead and liquidated than it is alive and operating.
That is dark.
It is. It is the absolute floor of valuation, usually driven by deep institutional pessimism regarding the company's ability to turn their operations around.
But Pasha looked at Intel, a foundational semiconductor manufacturer deeply embedded in U.S. national security interests, and decided the market's pessimism was irrational. He took a calculated risk on a turnaround thesis. He executed a similar strategy with PayPal, accumulating shares under $60, believing the market was mispricing its long-term payment processing dominance, waiting for a reversion back toward $100.
But a portfolio entirely composed of deep value turnaround plays is highly volatile. You can be right on the thesis, but wrong on the timing by 3 years.
True.
Pasha mitigated this risk by deploying capital into what he considered a defensive anchor, AutoZone.
And the logic behind AutoZone as a defensive ballast is brilliant because it relies on counter-cyclical consumer behavior. Explain that. Well, when the economy is booming and credit is cheap, consumers finance brand new vehicles, right? But when the macroeconomic environment tightens, interest rates are high, and discretionary income shrinks, people stop buying new cars. They're forced to hold on to their depreciating assets longer.
Right, they keep the old car running.
Exactly. And when a 12-year-old vehicle breaks down during a tight economy, the consumer avoids the high labor rates of the dealership. They go to AutoZone, buy the aftermarket part, and repair it themselves to save money.
So AutoZone's core business model intrinsically thrives during economic stress. Pasha utilized that steady, recession-resistant cash flow to stabilize the overall volatility of his portfolio, occasionally trading around the core position to scalp 10–15% gains when the stock swung on broader market sentiment.
And beyond equities, he engaged in a highly sophisticated macroeconomic fixed income play. He began accumulating long-term U.S. Treasury bonds. But he wasn't buying them for the 4% or 5% safe yield. He was buying them for capital appreciation because he was front-running the Federal Reserve's interest rate policy.
This requires a deep understanding of fixed income mechanics, specifically duration risk and the inverse relationship between bond yields and bond prices. Pasha observed the Federal Reserve initiating their rate-cutting cycle with a 50 basis point reduction, and he modeled that they would continue aggressively cutting rates as inflation pooled.
Let's explain that seesaw mechanic for a second. If I buy a long-term Treasury bond today that pays 5% interest and I hold it, I get my 5%. But if next year the Federal Reserve cuts rates down to 3%, anyone buying a brand new Treasury bond only gets 3%. Suddenly, my older bond that guarantees 5% is incredibly attractive.
Highly zero.
Institutional investors will pay a massive premium on the secondary market to buy my 5% bond from me. So the actual price of the bond itself goes up as the underlying interest rates go down.
Precisely. Pasha used long-term treasuries essentially as a cash position that actively appreciates in value as the central bank eases monetary policy. It's an incredibly astute macro trade.
It is. But looking at this entire breakdown tracking PE compression in Chinese tech, analyzing Intel's liquidation value, front-running the Fed's rate cuts, managing a portfolio of 16 individual assets including Ulta Beauty, CVS, Google, Berkshire, Meta, and constantly trimming positions on upswings. I have a massive pushback against this strategy for the average listener.
Let's hear it.
This isn't just investing $10 a day. This is a part-time job.
Oh, it is entirely a part-time job. The level of financial literacy, constant market monitoring, and emotional energy required to execute this successfully is immense.
Right. If you are an engineer, a nurse, a teacher, if you have a demanding career, a family, and a mortgage, do you genuinely want to spend your Tuesday evenings parsing through AutoZone's quarterly earnings reports and analyzing central bank monetary policy just to perfectly optimize a $10 daily deployment?
For 99% of the population, the answer is a resounding no.
Pasha's data definitively proves that $10 a day can generate massive alpha, but the hidden cost of that 29% return is your time and attention.
Which is exactly why the passive ETF strategy, despite yielding a boring 7.4% instead of 29%, remains the far superior and sustainable path for the vast majority of retail investors. Pasha represents the absolute ceiling of what active micro-investing can achieve. But the beautiful reality of the mathematics is that you do not need Pasha's 29% return to become incredibly wealthy.
You don't.
You simply need the boring 7% to 10% index return, compounded relentlessly over decades.
Which brings us perfectly to the final macro-level analysis of our deep dive. We've examined the acute 30-day shock of a carry trade unwinding. We've analyzed the one-year trade war endurance and the active stock picking sprint. Now we zoom out to the multi-decade horizon. We're looking at the wealth machine. 5, 20, and 30 years of consistent micro-investing.
This is the transition from simple linear addition to the explosive mathematics of compound growth.
Let's anchor this in the 5-year backtest provided by the source Mel Abraham. The premise is straightforward. Investing $10 a day, but strictly on the 252 roughly active trading days per year. So you are deploying roughly $2,520 a year. Over a 5-year period, your total out-of-pocket principal investment is exactly $12,590.
And Mel ran the historical data on what happens if you deploy that blindly, without any active management or market timing, directly into VOO, the Vanguard S&P 500 ETF.
The outcome is deeply compelling. After 5 years, that $12,590 of out-of-pocket cash compounded into a total balance of $19,090.
That's solid.
Yeah, that represents a 51.6% total return over the half-decade, averaging out to 10.3% annually. He ran the same backtest on VTI, the total market fund, which yielded $18,555, a 47.4% return. You are generating over $6,500 in pure, unadulterated, passive profit simply by redirecting the daily cost of a fast food lunch or a premium coffee into a brokerage app.
But the 5-year mark is merely the ignition phase of the compounding engine. The true architectural power of wealth building only reveals itself in decades 2 and 3.
If we connect this to the bigger picture.
Exactly. In the early years, the vast majority of your account balance is simply the principal you deposited. You're earning interest on your own cash. But as time stretches, the math hits an inflection point where you begin earning interest on the interest that your previous interest earned.
The snowball effect.
The growth curve turns parabolic. Mel Abraham's data extrapolates this beautifully, assuming a conservative historical average return of 10% on that $10 a day. If you maintain this mechanical habit for 20 years, your total balance hits $277,000.
Incredible.
And here is the critical shift in the math. At year 20, 69.7% of that final balance is pure growth. You didn't earn that money at a job and deposit it. The market generated it for you entirely independently of your labor.
And look at the acceleration as time continues. If you endure just 5 more years, moving from year 20 to year 25, the balance doesn't just incrementally increase. It skyrockets to $490,000. Now, 78.6% of the portfolio is pure compound interest.
And the ultimate horizon, 30 years. You invest $10 a day, every trading day, for 3 decades. Your final account balance is $847,000.
Over 85% of that final number, more than $700,000, was entirely generated by the mathematical force of compound growth.
And the source Jacob Wade corroborated this with parallel calculations. He modeled $70 a week, which is mathematically $10 a day, projected over 30 years at a 10% return, arriving at almost $700,000 in wealth from literal pocket change.
And this really connects back to Dom's story that we mentioned earlier. Dom started with just $10 a week for a year. That was his entry point. It wasn't about the massive capital deployment. It was about proving to himself that he could sustain the habit. You start with 10 a week, you graduate to 10 a day, and suddenly you are looking at nearly $1 million down the line.
When you lay those numbers out sequentially, they sound almost utopian. People instinctively reject the math because it contradicts the deeply ingrained societal narrative around wealth generation.
Right. We are conditioned to believe that building $1 million net worth requires, inventing a disruptive tech app, inheriting a trust fund, or grinding out a massive 6-figure executive salary.
But Mel Abraham explicitly dismantles that myth using empirical data. He references a comprehensive study analyzing the backgrounds of 10,000 millionaires.
10,000 is a massive sample size.
It is, and the data shatters the inheritance narrative. 79% of the millionaires in the study were first-generation rich. They received no inheritance. They built the wealth entirely from scratch. But the most vital statistic, the one that completely rewrites the psychology of finance, is this. 31% of those millionaires never made more than $100,000 a year at any point in their entire careers.
Nearly a third of the millionaires in the sample size never commanded a high-income salary. They were school teachers, municipal workers, middle managers, tradespeople.
They did not earn their way to $1 million through their labor rate. They systematically compounded their way there through disciplined capital allocation over time.
As Mel states in the source, you cannot save your way to wealth. You must invest your way to wealth. He provides this stark mathematical contrast. If you are deeply risk-averse and you stubbornly insist on safety, saving $5,000 a year in a traditional bank account, earning a generous 2% yield over 40 years of a working career, you will retire with roughly $314,000.
Which is a respectable sum.
It is. But if you take that exact same $5,000 a year, accept the inherent volatility of the equity markets, and average an 8% return, you retire with $1.5 million. It is the exact same out-of-pocket financial sacrifice, but it results in a drastically different physical reality in retirement.
And this reveals the ultimate hidden psychological value of the $10 a day challenge. The $10 itself in the first few months isn't actually making you rich.
Right.
The true value is the habit execution in the emotional judgment you are building.
What do you mean by building emotional judgment? Are we talking about risk tolerance?
Exactly. Consider an investor who begins deploying $10 a day at age 22. In their very first year, the macroeconomic environment shifts and the market crashes 10%. Because they only have a few $100s of principal invested, their portfolio drops by like $40.
It stings their pride, but it doesn't imperil their ability to pay rent.
Right. But they physically experience the sensation of a market correction. They learn how it feels to log into the app and see red numbers. They learn to suppress the panic reflex. Most importantly, they learn the mechanics of continuing to buy the dip automatically.
Ah, I see where you're going with this.
Fast forward 10 or 15 years, they are now 35, earning a larger salary and actively investing $500 a week. When the next inevitable global macroeconomic shock occurs and their six-figure portfolio suddenly violently drops by $30,000, they do not panic.
They don't sell.
They do not liquidate their positions at the bottom.
Yeah.
Because they have seen this exact cyclical pattern before. They built their emotional immunity when the financial stakes were practically zero.
The $10 a day is effectively training wheels for your financial psychology. By the time you actually accumulate significant wealth, you already possess the exact operational temperament required to manage it. You know exactly how to navigate global trade wars, margin call liquidity crises, and broad market corrections without blowing up your financial life. You've paid a remarkably cheap tuition to the market to learn the hardest lessons in finance.
You are paying for the emotional battle scars that prevent you from making a catastrophic, portfolio-destroying decision when the real money is on the line. Patience, emotional regulation, and mechanized consistency are skills that must be practiced.
So we've unpacked an incredible spectrum of data today. We've seen how the back-end clearinghouse technology of 2026 has completely obliterated the traditional barriers to entry, allowing anyone to slice a fraction of the world's most premium assets with zero friction. The gates to the financial ecosystem are wide open.
Truly open to anyone.
Whether you choose to operate like Pasha, dedicating hours to meticulously analyzing forward earnings multiples and liquidating assets on stimulus spikes to hunt for massive alpha, or whether you choose the mathematically proven path of the passive investor, stubbornly acquiring a broad index ETF every single morning, blindly walking through global geopolitical shocks and central bank policy shifts, trusting the 30-year compounding curve to eventually deliver that $800,000 nest egg, the absolute most expensive, destructive mistake you can make right now is choosing to remain on the sidelines.
Because time is the single variable in the compounding equation that you can never manipulate or replenish. Every single day you delay initiating the habit is a massive segment of exponential growth on the back end of the curve that you are permanently surrendering.
Look at your daily operational habits. Where is your $10 hiding? Is it trapped in an unutilized subscription service? Is it burned on hyper-convenient food delivery? Reallocate that capital. Shift it from a depreciating expense column into an appreciating asset column. Start with $10 a week if you have to. But as we look at the sheer scale of what this technology is enabling, millions of individuals suddenly allocating capital directly into equities, I want to pull back and look at the structural implications. Based on all the source material detailing the rise of the microinvestor, what is the macro conclusion we are heading toward?
If you extrapolate the reality of what zero-friction fractional investing is doing at a systemic scale, it forces a fascinating, almost slightly unnerving reevaluation of corporate governance.
How so?
Historically, the massive Wall Street institutions, the legacy pension funds, the sovereign wealth funds, the multi-trillion-dollar asset managers like Vanguard and BlackRock held absolute voting dominance at shareholder meetings because they controlled the massive blocks of whole shares.
They dictated the terms.
But we are now seeing millions of everyday retail investors, through streamlined mobile apps, continuously buying tiny $10 slivers of these megacorporations. If this micro-investing behavior continues to scale exponentially, and tens of millions of retail investors aggregate their fractional holdings into massive decentralized ownership blocks, what happens to the power dynamics of corporate governance?
Oh, wow.
Do everyday retail investors suddenly possess a massive hidden collective voting power that institutional Wall Street hasn't fully priced in yet? Could a decentralized, highly coordinated movement of $10 a day investors eventually wield enough aggregated equity to force a Fortune 500 board of directors to fundamentally alter their environmental policies, their labor negotiations, or their executive compensation packages? The complete democratization of asset ownership might inevitably lead to the democratization of corporate control.
It fundamentally changes the definition of retail influence. We aren't just systematically purchasing our own financial independence. Collectively, day by day, fraction by fraction, we might be buying the steering wheel to the global economy. It brings us right back to the very beginning of the data. We want the clean, perfect X-ray that shows us exactly what the future holds. But the macroeconomic world is deeply, inherently chaotic. But the brutal, relentless mathematics of compound interest is the closest thing to a perfect diagnostic tool we will ever get. It does not promise you a smooth ride, and it guarantees you will experience volatility, but it perfectly maps out the destination if you simply refuse to get off the table. Thank you so much for joining us on this deep dive into the data. Keep demanding the actual math, keep pushing back on the institutional noise, and stay curious. We'll see you next time.